Mhm. Salam, Ibrahim. I think we can tell you, Ibrahim, just to make sure it's not only me.
صباح الخير إبراهيم.
Okay, I'm sorry. I was silent. Okay, right? Mic is muted, sorry. Okay. Now everyone
سامعينك تمام
here.
شكرا.
Okay,
Yes,
thank you.
yes.
Thank you. So when is the last time? I think I did it wrong. So to recap, recap the last part. I'm sorry. It's the first time I'm doing like this type of like a course online. So apologize for any mishaps. So I see Abdurrahman Mili. Do you have a question? No. Okay. So the safe, as I told you, the safe is has three metrics. Has
Ibrahim, just to make sure, I don't think we heard anything from the beginning. Just for your information.
okay. Okay, so good morning, everyone. I'm happy to be here with you. I've been talking for like 15 minutes without knowing that nobody's hearing me, so I'm sorry for that. So as a housekeeping rule, I will structure the course into more than two or three parts. So after each part, I will allow I will allow you to raise any questions you might have. Um, and please just keep your mute on so that there would be noise in the background. Um, I'm to give you an introduction about me if anybody doesn't hasn't heard about me or doesn't know me. I'm a corporate lawyer. I've been working for the past 13 years, and I've been working in the venture capital space since 2017. I represent startups and I represent also venture capital funds, accelerators, incubators, and others. And I work as a partner at Shahata and Partner Law Firm. I do my work in Egypt, in Saudi, in UAE, in Lebanon, Tunisia, South Africa, and also in the other jurisdictions where there are holding companies like US, Netherlands, and the UAE. Um, so, uh, as a start, I would start by saying like what is a venture capital? So this PDF document you can see on the screen will be shared with all of you after the course. Um, but I will start by talking about an intro to venture capital, and then I will talk basically about the two main types of rounds that take place for investments in startups within the world of venture capital, of course. So, as an introduction, the type of investors in venture capital, we can categorize them into three levels. So, we have the first level, which is the family and friends, and we have the second level, which is the angel investors, and we have the third level, which is the venture capital firms. The first level, family and friends, don't usually enter into agreements. Okay. Uh, Christine, do you have a question or you cannot hear me or anything like that?
It's a request, Ibrahim. Can we record this session if you don't mind?
Yeah, it is recorded. It is recorded. It is recorded, yes. Okay. So going back, so we have family and friends, and we have angel investors, and then we have uh, uh, venture capital firms. So for family and friends, they usually don't enter into agreements or enter into like safes or anything like that. Sometimes they do, but that's not typically the case. So then we go to angel investors. They usually enter through safes or through convertible rounds, which safe is the most popular format for it. And then venture capital firms are usually entering through either safes or term sheets and equity rounds, depending on the type of the venture capital firm and whether they are investing at pre-seed or seed stage, or they are investing at a later stage, like for example, Series A and Series B, and so forth. If they are investing at the pre-seed or the seed stage, then they usually invest through safes. And if they are investing at a later stage, like Series A and so forth, they will invest through equity rounds or equity term sheets. Okay, so as far you can see, there are two main types of rounds: priced rounds and convertible rounds. Convertible rounds is like, have different flavors. Like there's SAFE, there's KISS, there's the convertible loan agreement, the original one. But I can say like 90 or 95% of the time right now, everybody is using the SAFE. The SAFE is an acronym for Simple Agreement for Future Equity. It has been created by the Y Combinator, and it's very popular all over the world, not only in the US, but it's very popular in the MENA region and in other parts of the world as well. So the safes, I will talk about the two core differences between the original convertible loan and the safe. There are two main differences. The first one, the convertible loan has a maturity date. So it says, like, for example, if I pay $100,000, and in 1 year, this $100,000 will either I will get them back with interest, or they will be converted in equity as per the valuation that we have put in place from day one. So the two differences is that you pay interest rate and it doesn't, and it does have a maturity date. When the safe came, it altered the picture a lot. So they removed the maturity date and the interest rate. Why is that? Just to make sure that it is more comfortable for the startup founders, that there's no time ticking that is happening all the time, that I need to raise or I'm gonna get someone get equity at a lower price and so forth. So that's why the safe became very popular, because it doesn't have a maturity date and it doesn't have interest rate. So these are the two main
one more
differences.
time. We see still the first page. Just make sure you're not exchanging. It is
Yeah,
the same page.
I'm on the first page still, yes.
Yeah, perfect.
I'm in item B, convertible round safes, item B1. So, and I'm talking about the differences between convertible loans and safes. So, as I told you, 90% of the time, the safe is the version that is used. It's a format of convertible note, but has these two differences: no maturity date and no interest rate. Uh, for the interest rate, there is no substitution, just no interest rate. For the maturity date, it's switched to what we call a triggering event. So when does this safe will convert? It will convert at a certain event, which is the day when I will raise equity, which means the price round. So, for example, I opened this company today at 1st of January 2025. I raised safes in 1st of February 2025, and it doesn't have a maturity date and it doesn't have an interest rate. And then I raise another round of safes in 1st of June 2025. Then I raise equity in 1st of January 2026. So in this scenario, the safe will not convert by the first convertible round, by the first safe. So in February, when I did the safe, and then I did another round of safe, this another round of safe doesn't impact the first round of safe. They're still outstanding. They still didn't convert. But when I do the equity round in 1st of January 2026, 1 year or almost 1 year later, at that time, that's what we call the triggering event. And at that time, both rounds of safes, the first one and the second one, will get converted. So that's why sometimes investors get frustrated a little bit that a lot of investors, a lot of startup founders raise safe rounds like one after another, after another, after another, and they might raise it for like 4 or 5 years, and it's only safes, and they feel like that might impact them, that they still don't have equity and so forth. That's why like there is usually what we call some side letters, some special agreements, some amendments that is done to the safe to return the maturity date. That's something that I've seen, but it's not, of course, like that's something that happens a lot, but sometimes it happened in my career. So just that you know that this is how safes can be abused. They can be abused by raising safes all the time and avoiding raising any equity, and that can continue for a long time. Okay, so I'll stop here. Before I stop here, I will talk a little bit about the price round, the difference between the convertible round and the price round, and then I will stop to take some questions and then continue later on. So as it said, the convertible round is two pieces. The first piece has what the metrics that we put in the safe itself, which is the investment amount, the valuation cap, and the discount rate. And these I will talk about later. And then the second half of the story is at the time when there is a triggering event, which is the future price round. So that's the time where the safe becomes equity. Okay, so that's the convertible round. For the price round, no, it's a very different story. It's similar to M&As. It's like I pay money today for equity that I get today, or I get in like 1 or 2 months after satisfying certain conditions, like conditions precedents. So it's very different. And it's quite similar a little bit to mergers and acquisition, but of course has different clauses and different conditions of how they can be of relating to the the founder's rights and the investor's rights. But in terms of the mechanics, it's very similar to what happens in M&As. So I hope that the differences are clear, because this is like the basic one of the things, the key things that you have to understand before delving deep into each round separately. So if anybody has any questions now, please raise them. I will wait for 1 minute. Okay. Muhammad Sharif, please go ahead.
Hi, doctor. Can you hear me?
Yes.
Right. So I understand that there's a difference between the convertible rounds and the priced rounds, but I feel like we can dig deeper into the definition of what are rounds,
Okay.
be it convertible or priced, because I feel like there's a gap in the basic understanding of what the round is
Okay.
in the first place. Thank you.
Okay. Round. When I say round, I mean like a startup founder that's trying to raise money. So how he raise money, he can raise it in the format of a convertible round or in the format of an equity slash price round. So this is basically what we mean by rounds. Does this answer your question?
Uh, yeah, sort of it does, but what I'm trying to understand is how, like, the mechanisms of raising rounds. Like, is it like issuing shares or issuing stocks or something like that? What does and how does it work?
Okay. I will tell you a little bit. Okay, I will answer your question. Okay, one second. Ahmed Barambali, right?
Right. Right. Yeah, just to a question. So, in that case, Ibrahim, what I understand from what you explained is any startup founder would prefer to go for a safe note, given that there's no maturity date and there's no interest, which is better for them. And the opposite from the investor side, the investor would prefer to go for convertible, not for safe. So, why would any investor go for safe, given that there is no maturity and there's no interest? What's in it for them? Like, why would they go safe if they have the other options?
Okay, that's a good question. I will tell you. I will tell you why. Yasser?
Yes, can you hear me now?
Yes.
Okay, so adding to Muhammad's or Mahmoud's point, actually, you mentioned that in the convertible rounds, or in the safes agreements, there can be some sort of abuse when it is done on a yearly basis or an annual basis. So that
I
the
don't mean animal. Like I mean like that you
Mm,
can like there is no limitation on how many safe rounds you can do. So you can do
mhm,
one today, another one after 6 months, another one after third one after a year, and
mhm,
continue doing that. And by that you will have only outstanding safe without anyone converting to equity for some time. And
mhm,
this thing sometimes bothers the investors.
mhm. This is actually my question. How can we guarantee, or what kind of clause that we can like incorporate into the agreement so that there is no such thing, or there is some sort of a warrant or a guarantee for the investors that such practices are not executed normally? This is what I'm saying.
You will have to return the maturity date, saying that like by the date by like 1st of January 2026, I'm converting to equity whether you are raising or not raising or doing whatever you want.
Many thanks.
Okay. So going back to the two questions, for Muhammad question, like when I say round, I mean fundraising rounds, which means that the startup founder would go and raise money. So what is issued to the investor? I think that's your question. If it's a convertible round, what is basically issued is a safe only. So the safe is the only guarantee of your right. It's a document, a contract basically, but is that signed by the company and by the investor that says that they will do this and this and this if something happens and blah blah blah. I will talk about all the terms of the safe later on to make sure that you understand. But basically, this is what is issued. This is a safe document only, and it's done by DocuSign, and that's it. If we're doing priced equity, then there is shares that are issued. Priced equity round, then there are shares that are issued. Of course, the timing of the issuance of the shares depend on the agreement itself, if there are conditions, precedents, and so forth. I hope that answers your question. If you need any clarification, you can send them on the chat. Uh, as for Ahmed question about why investors go for the safe, actually the safe is a founder friendly more than an investor friendly document. So it's basically something that is used for the benefit of the founders more than the benefit of the investors. Why they are going for it? Because like that became the practice. Like that's something that they don't do it out of like that they have a choice. It's just became the norm. And some sophisticated investors try to put like guaranteeing metrics, like for example returning the maturity date or doing some tweaks on the safe to make sure that it is not abused. But the problem is that it's just became the norm. But if you see online, it's definitely something that is pro founders than investors themselves. I think the only way, and I've seen it two or three times, the only way that you would abuse the safe is if you continue raising safe rounds for a long time and don't convert them into equity. And the only way to avoid that is to return the maturity date close to the safe itself and make it based on a maturity date rather than based on a triggering event. And of course, this is usually not an option. But also, I need to say something about safes. The safe are actually became very popular not just because they are founder friendly, but because they are easier to negotiate. And at the time, the safes are usually issued at the time of pre-seed and seed rounds. So at that time, the valuation is not clear. So it's better to have an equation than to have a clear cut like deal on equity for both sides, because they don't know, maybe this company like will go bust, this company will go like will fly. They don't know that at the time of signing the safe. So that's why, that's another reason maybe it is used that much, because it makes it fair and square for everybody. They say like, if this happens, that will happen. If this doesn't happen, that will not happen. And that helps everybody with like consummating or like finalizing the deal. Does that answer your question?
Doesn't point, but still doesn't answer why don't you go for convertible given it's almost the same except there's an interest on the money as well. Isn't it
Interest on the
also
money,
fair
because
for both?
if you are in the business of getting interest, you should put it in the bank. Startups are not about getting interest. It's starting about going flying or busting. So it's not, you're not looking for 5 or 10% as interest. You're looking at an ROI of like 50, 60, 70% at least, and maybe like multiples of like 5x, 10x. So that's why they don't care much about the interest.
Yeah.
Okay. Okay, I will go back. So the safe, what is a safe? Uh, what is a safe? The safe as I might not have said that. The safe is a document or a template contract that has been prepared or has been developed by Y Combinator. Okay. I think everybody knows Y Combinator. So it's a template that's used there, and if you go to the link here that I'm seeing, you will see different templates. So one template for US based companies, another for Canada companies, a third for Singapore, and a fourth for Cayman Islands. These are the four jurisdictions that they have developed, but that doesn't mean that the safe is not used in other jurisdictions. It's used almost in every jurisdiction. But of course, you need the help of a lawyer to make sure that it is tweaked in the right manner to be adaptable to that jurisdiction. So, for example, in the one that they have done for the US, there are several, like, clauses relating to the SEC and the registration of shares in the US. So these are not relevant if if the holding company of the startup is based, for example, in Egypt, or is based in the UAE, or is based in Saudi, or is based in, like, Lithuania. It's not relevant. So that's why you need someone to have a look at the safe document to tweak it to the jurisdiction where your holding company is placed. So this is just an advice. Safes, when they were created, they were called pre-money safe. And in 20, I think 20, I don't remember the exact date, but now the current version is not pre-money safe, it's post-money safe. That's an important thing to talk about. What is a post-money safe and what is a pre-money safe? A pre-money safe means basically, and I'll try to talk in layman's term as much as possible. Basically, if I raise four safes, A, B, C, D, like safe A, safe B, safe C, safe D. If all of them are pre-money safe, then this means that they will dilute each other. So they will not, in the calculation, they dilute each other. This means that they are more founder friendly than investor friendly. So the more safes you raise, this means that the additional safes dilute the original safes, which became a problem because you can raise safes and the other safe holders don't know that you raise safes. There's no obligation that you notice or notify the original safe holders. So in my case, for example, if I raise safe A and safe B in January 2025, and then raise safe C and D in June 2025, and they are all pre-money safe, then the new safes will dilute the original safes, and the original safe holders wouldn't know that until the time that there is a triggering event, which could be a year later, and that's when the company raises equity. So that became problematic. And that's why the post-money safe came in action, I think in 2018. I don't fully remember the day, but I think in 2018. And this is very different. It's the opposite. They don't dilute each other. So for example, that's a very simple equation. If I put, you can see it here. If I put, no, this is for the valuation cap discount rate. If I put $100,000 at the valuation cap of $1 million, then it's clear that I get 10% of the company, no matter what happens with the other safes. So it's a post-money safe. It has a different calculation type, and this type of post-money safe has become more investor-friendly because I know from day one till the day that the equity event is triggered, that how much percentage I will get if I use the valuation cap at least. The discount rate is the other metric that you will have to wait till the equity event to know how much you will get. And to tell more a little bit about this, because I know that some of they are isolated, but they are also connected with each other. So the safe, just so that you know, whether it's a pre-money safe or post-money safe, any safe, it gets, as I told you, it has two inputs. The first input today is three things: the investment amount, the valuation cap, and the discount rate. The second type of input is the valuation, or the what we call the pre-money valuation that you will raise at in the future. So that's something that we don't know today when we sign the safe. So for the safe, so the investment amount is clear. It's like, for example, $100,000, and then the valuation cap, let's say it's $1 million, and then we have the discount rate that's 20%. Okay, so in the post money safe, the safe, how most safes are used, they tell you that you will get whatever metric will give you more shares. What does this mean? Yani, there are two actually separate equations. So one equation to calculate how many shares you get if we apply the valuation cap, and another equation we do to know how much shares you will get if you apply the discount rate. And then you compare both of them and see which one gives you more shares and choose that. So this is that's for the regular safe, which has both metrics. So valuation cap and discount rate are done like that. In the post money safe with the valuation cap, you know from day one how much percentage you will get. But if you have the other metric, the discount rate, you will not know from day one, because basically the discount rate, it's a discount on the future price per share, which will be tied to the valuation that will be put in the valuation in the equity round. I will say it one more time because I know it's a little bit tricky, and then I will open the floor for questions because this is something that is very important to understand in safes. So let's talk about post money safe for now because that's the most common one now and the most important one. If you see a document with a pre-money safe, then you will have to understand what does it mean and see how advice is given on the basis of who you are representing. But I'm talking now about the post money safe. So the post money safe, we have the first half of the equation has three metrics. One is investment amount, and one is valuation cap, and one is discount rate. The investment amount, for example, is $100,000. The valuation cap is $1 million. The discount rate is 20%. Based on that, there's one equation that is solved from day one, which is the valuation cap. So you know from day one that you will get 10%. And it could be diluted a little bit, but very minimal dilution. And in the second half of the equation where we use the discount rate, it depends on the future triggering event because it's a discount on the future. So if it's a 20% discount, it will be 20% on the price per share of the future. So we will wait anyway till the future and see which equation will give me more shares, and I will choose that equation. So if the 10% given by the valuation cap is more, I will take the 10%. If, for example, the discount rate gives me 7%, then I will not take it. If it gives me 12%, then I will take it. So that's how it is basically done. And that's how basically it's done. And you will see I have some links that explains that more because you need to read it as well to make sure that you understand it. But I think it's best to open the floor for questions now on this specific issue, which is how the safe works, how it get converted. It's clear, just say clear because, yeah. Ashraf Tariq, yes.
Hello. So my question is, considering that safes lack statutory recognition in most MENA jurisdictions, so how do we advise the clients to structure the safe to avoid any enforceability issues?
So basically, as you know, in the MENA region, you usually have a dual structure where you have an operating company, for example, in Egypt, and you have a holding company outside of Egypt. So usually the safe is raised at the level of the holding company, whether it's like Delaware or the UAE or ADGM or the IFC or Netherlands. So that's in all of these jurisdictions, they don't have a problem. But if you raise it in Egypt, for example, and you don't have a holding company yet, you can add a clause to the safe saying that it will be assigned to the holding company once it says created, so that you can avoid any issues and that the investor would become like, more content with that clause. Does this answer your question?
Yeah, thank you.
Okay. Ahmed,
Yes.
I'm not sure I'm saying
You just say
Brambali.
yeah.
Ahmed.
Yes,
Because
Ibrahim.
there are a lot of Ahmeds. That's why I'm saying.
No. How do you decide on the valuation cap? Is 10% the best practice, or are you just giving it an example?
No, this is just an example. The valuation cap can vary differently. I'm just saying it an example. I will
But
tell you
still,
about that
you don't know the
specifically.
valuation versus the money that you're putting in. Like, how do you decide on this? Because if you do know the valuation, then you can just raise rounds. You don't need safe. I find it tricky how you decide, given that the nature of the safe
Yeah,
stage is you don't need the valuation anyways.
you don't need a valuation, but you must have a valuation cap or a discount rate. You can have it with a discount rate only. But I will talk about, most of the people use the valuation cap because it's easier and it's more and it helps the founders later on to have a sense of what the valuation of the company is. But I will talk about this specific part in the general tips to founders later on like how much valuation cap they have to put in the safe. Okay. um, منير جاد
Yes.
الأولى. yes.
Hello. I'm sorry, I happened to have joined like 30 minutes late because I was engaged in something else. So will you share with us the video and this
Yeah.
sheet,
Yes.
the recording and this sheet? You will share it with us, right?
Yes.
Okay, it's perfect. Thank you.
You're welcome. أحمد سالم.
Yes, first, thanks for your session.
You're welcome.
Second, I was thinking about how if we apply the discount rate, it will be better than the valuation cap. I think in all cases, the discount rate will decrease the shares, right?
In all cases, the discount rate will what?
Decrease the shares.
Most in like 70% of the time, the valuation cap leads to a higher number of shares. The discount rate has to be higher than 20%, and the valuation cap has to be like, excessively high so I will go through as an example on the platform to show you and to play with it and show you the different scenarios of what will happen. So that's something I will answer later.
Thank you.
You're welcome. Ziad? So nobody has any. Okay. Um, okay. So this is I will talk about there's a paragraph here, but I will talk about it later in the platform. So let's talk about the safe side letter. So along with the safe, there's usually, or not usually, it depends on each round. This is like, I would say 40% of the time that this is asked from us to do, which is a safe side letter. This is a separate document between the company and the investor. And it usually has two main rights that are being given to the investor. One is called pro rata right, and the other is called MFN right. Pro rata right means I'll tell you what it means. So it means like, for example, if the safe leads to me having 10% in the future, I have the option, and not the obligation, I have the option to participate in the next equity round to make sure that I don't get diluted in the future. So it's like just this a tricky thing here. So the safe is created in January 2025. Then there's an equity round in June 2025. I get converted in June. Then there's another equity round in January 2026. The possible ramifications of this next equity round that I can get diluted after I got triggered. So here by this pro rata right, I make sure that I have the right to participate in this second equity round to make sure that my percentage that I got don't get diluted. So, and this is on the new price. Yani, it doesn't mean that I'm getting a preferred right, but it just means that something that gives you some ability to make sure that I'm involved in the situation and that I get that right. Usually, this is not something that is highly negotiated because usually when I get converted in June 2025 with the first equity round, then that's where usually there's a shareholder agreement, and you will have a lot of like metrics like preemption rights and right of first reviews and all that, and that will cover the pro rata right issue. So that's usually not something that that everyone negotiate hard to get it. What they negotiate hard to get is the MFN right. And the MFN right means basically I raise one safe today in January, I raise a second safe in February, a third safe in March, a fourth safe in April. For example, the first safe that you raised from me, you gave me a valuation cap of $1 million. But the fourth safe, you gave a valuation cap of $750,000, which is better. So the MFN right means that, which is a acronym for most favored nation. It means that I pass through and I get whatever benefits, additional benefits you may give to subsequent investors. So if you compare safe that you sign in January and the safe in April, we will find that the safe in April is better because it has a lower valuation cap. So if I have this MFN right, this means that my valuation cap is converted from $1 million to $750,000. So that's the MFN right, and it can be written in the safe itself, or it can be written in a side letter. One of the things that I said before, but I will talk about also again, that there are several versions of the safe on the Y Combinator platform, and it's very important to have a lawyer to look at, what version you're using and if that is consistent with the holding company or the jurisdiction where your holding company is. And one thing that is very important is that, all of them are missing a dispute resolution clause. And this becomes tricky, especially because they did it for the US basically. So like everybody in the US, so they will go to US courts. But if you have like investors from all over the world and you have the holding company in different jurisdiction and the assets are like in the operating company in Egypt and all that, then it's an arbitration clause is a must to make sure that the award is being like enforced in a cross-border format. So that's and the last issue here is the calculation of the safe. You will see a link that shows how the calculation of a pre-money safe is compared to a post-money safe. And you have to worry about the post-money safe more because that's the most common format right now, much more common than the pre-money safe. Pre-money safe was used before, but some people because they don't get right advice, they might have it an old version and use a pre-money safe, and they don't know that, and that becomes a problem actually. Okay, so that's the safe. I think I covered most of the things in the safe. I will leave the floor to questions and a 5 to 7 minute break, and I will come back later. So if anyone has any question, you can raise it now. We can answer the questions and then go for a 5-minute break and then come back. Ziad, yes?
Hi, so I typed the question earlier in the chat, but I think you didn't get the chance to look at it. Basically, what I was asking is if in the scenario we have that company raises like several safe notes, and there is a triggering event to like swap to equity or convert. How is it managed? Like how is the sequence of conversion of the different safe notes is handled, because it could affect the dilution of each investor, I guess. So is it affected by the pro rata, or how is it?
Not the pro rata. The pro rata is a different thing, and it's not
Yeah.
something that you need to focus a lot on. But what you're saying is what I was talking about with the difference between a pre-money safe and a post-money safe. If we are raising several rounds of safes, or like 1, 2, 3, 4, 5, 6, 7 safes, and all of them are pre-money, or like some of them are pre-money, the pre-money safes will dilute each other. If I'm raising or if I'm given a post-money safe, I will not get diluted by other safes. So that's why the investors became very clear that usually they request a post-money safe, not a pre-money safe. That's something to make sure that I don't get diluted by the other safes that you raise. But the situation before that version, that it was tricky and it was like very burdensome, and that's why like most people didn't like it, and that's why they changed it from a pre-money safe to post-money safe. Does that answer
Okay,
your
thank you.
question? Yeah.
Yes, yes, thank you.
Any other questions? Okay. So it's 12. Now if it's there are some questions. Oh, okay. So now it's 12:58. We'll get back by 1:05, or it's 12:59. We'll get back by 1:05, 1:06. And if anyone has any questions on the first part, please send them over the chat and I will answer them once I come back. And if anybody has any feedback as well to improve the second part of the session, please go ahead and share your thoughts. Thank you. Okay, I will start in 1 minute, inshallah. Okay. So we talked about the convertible rounds. As I told you, just a recap on the previous part. So we have two types of rounds, convertible rounds and priced rounds. They called priced or equity, and this is called convertible round. The convertible round, there are different formats of it. The most popular one is the safe, and that's one that I talked about the most. So 90% of the time it is organized via safe. The safe has two main clauses relating to the valuation cap and the discount rate, and how it is converted depends on like the equation that is put in place today and what will happen in the future event, which is the equity round. And also talked about the MFN in the safe and how it is important to be able to know what does it mean exactly to make sure that you give it to the right investor and not to every investor, because it's a huge right. What else? We talked about the pre-money safes and the post-money safe. The pre-money safes dilute each other, and the post-money safe don't dilute each other. Now I will talk about the price round. I will just wait for 1 second and I will start right away. Okay. So the term sheet. Okay, let me tell you a little bit about um, equity rounds. So equity round, as I told you, as we talked a little bit earlier, it means that I pay the money and I get the shares like right away. It's not like based on future events or anything like that. How does the equity round start? It starts with a term sheet, and the term sheet is usually a non-binding agreement with some exceptions. Like the most important exception is usually the negotiation period or the exclusivity period. What does this mean? Yeah, the term sheet is basically summarizes the most of the commercial terms and says that me as an investor and you as a startup founder will have like a period of 2 to 3 months to turn this term sheet into a binding document, which I will talk about what exactly the document would be. But basically, it's either a shareholders agreement and subscription agreement or one document for both shareholders agreements and subscription agreements. This depends on like the situation of the company and like the cap table and how many previous shareholders they have and how many safes they have and how they will convert and the negotiation with the other shareholders and so forth. But the term sheet itself is non-binding. It has some clauses that are binding, mostly confidentiality, exclusivity period, something relating to the governing law and the dispute resolution clause, the notices clause, but that's basically it. Okay. There are some terms in the term sheet that needs to be like explained a little bit. So pre-money valuation and post-money valuation. When you say I'm raising $100,000 at $1 million pre-money valuation, this means that you will not divide the 100 by the 1 million. This means that you will add them up, 100,000 plus 1 million. You will get to the post-money valuation, and then you will divide the investment amount by the post-money valuation, not the pre-money valuation. So $100,000 is not equal 10%. If you calculate it right, $100,000 will be equal to divided it will be equal to 9.09%. So it's a big difference, especially in good startups. So that's what's important that you note, that when you say a certain thing, it means something in calculation that could be not foreseen at the time, that if you don't know the definition. Okay. There are some terms that are usually put into a term sheets, and I divide them basically into like some relating to control issues and some relating to economic issues. So usually a company is managed or is administrated as follows. You have the first level, which is the management level, CEO, CFO, which is basically done by the founders. And then you have another level, which is the board of directors. And then you have a third level, which is the shareholders, the guys that own the company. The management usually do the day-to-day. What we do in the term sheet, that we say, for example, that there are certain decisions that the management cannot do without obtaining the approval of the board of directors. And also, we say that there are certain decisions that the management cannot do without obtaining the approval of the shareholders. So two different types of decisions. For example, I can say, like, if the company wants to take a loan of $1 million, they have to get the approval of the board. But if they want to get a loan above $1 million, then they have to get the approval of the shareholders, which is a much more a higher level, and it's more difficult to get. So that's what we call the reserved matters or protective provisions. The board composition in the term sheet, we say like the board composition is basically relates to how many board members will be appointed by the founders, how many board members will be appointed by the shareholders, the other shareholders, which could be the safe holders and could be the investors, the new investors that are coming into this price round. Also, some issues relate to that. You can appoint a board observer, guy who attends the board meetings but doesn't have a vote. You will have some certain, like, language about like what is the quorum for attending a board meeting and what is the quorum for voting in a board meeting, which is very important to put in place in the term sheet. Okay, so before I go into more provisions, I will stop here and see if anybody has any question about about the board composition or the reserve matters or the pre-money about these first four issues. Eli, Aizer.
Yes, hello. Thank you for this valuable session. I'm a lawyer from Lebanon, and I do work for large companies based in the GCC. And I'm highly interested in this because there is a lot of technical issues that I have been missing this time for some time, especially that I'm young. I don't have this expertise. So thank you for your valuable opinion. However, you have said that the company is based, or every company or joint venture or whatever is the type of the company, is based on three levels. Let's say there are the director, there are the management, and there is the shareholders. However, don't you think that the management or the base level should have their authority limited in the articles of association? Because uh, every startup, or I'm taking it from a pure technical level, uh, every startup or every company has articles of association that are based in a commercial register. So don't you think that the lawyer that is incorporating the company should be smart enough to take into consideration all these factors? Thank you.
Thank you, Eli. So basically, what happens is like the company has been created before the equity round, so they have their own articles of association with saying, like, for example, that this and this has this authority, and the board, for example, has this authority, and anything like beyond that should be the call of the shareholders. So when we enter into a term sheet, the term sheet, as I said, told you, it's non-binding. But then you have the definitive documents, which is like either the shareholders agreement or the subscription agreement. And in these documents, you design the system. You say like the three levels: the management, the board of directors, and the shareholders. And you would have a clause there that would say that you, as a founder or as a company, has to amend the articles of association as much as possible to accommodate or to make sure that all the provisions of the shareholders agreement are reflected in the articles of association. And in the event that you're not able to do all these changes, in any case, what is written in the shareholders agreement is what prevails in the relationship between us. So you cannot say like, because these articles are not amended, then they prevail. No, the SHA or the shareholder agreement is the one that prevails. So that's usually how it is done. I don't know if I answered your question this way.
Yes, you technically did. Thank you for providing this valuable opinion, and I look forward to be able to have a discussion about restructuring, which is something else. So once your schedule allows you to visit us in Beirut, you are more than welcome.
Yeah.
And we would like to have a great discussion with you. We're a huge team here in Lebanon, and we do work on important matters, and we do need your opinion as a valuable expert.
Of course, of course. I will leave my contact details, and I'm always reachable via LinkedIn. But I will leave my contact details, my email, and my phone number. If anyone needs any questions, of course, I'd love to answer them. Okay. So going back to the document. Uh, So anti-dilution is one of the tricky things, but I need to make sure that everybody understands when does anti-dilution is triggered or when does it get triggered. So anti-dilution gets triggered when there's a down round. What does this mean? What does a down round means? A down round means that I raised today equity at a pre-money valuation of $1 million. And then in 6 months, I'm raising equity at a pre-money valuation of $500,000. So this raise of $500,000 is what is called the down round. And this is what triggers an anti-dilution clause if you have it in place. Anti-dilution clause is basically there's two flavors. One is called full ratchet, and the other is called broad or weighted average, which can be broad or narrow. That's two subcategories. But basically, the two main categories is full ratchet and a broad or weighted average. The full ratchet is basically they have each one has its own equation, but basically in layman's term, full ratchet gives more shares to the investors than the weighted average. So it's basically what happens is that the company issues free shares to the investors to make sure that they are not diluted in that down round. If you have the full ratchet clause, then you are compensated for almost 100% of what you're going to lose. If you have a weighted average, then you will be compensated for a slightly less. And if you don't have any anti-dilution clause, you will not be compensated at all. So this is one of the things that usually is pressed on or usually negotiated very carefully because you want to know what will happen, especially if you are still at an early stage in the startup. Right of first refusal and preemption rights. I usually like to talk about them both in the same manner because the difference is very critical or very slight. Um, Basically, they both have the same meaning, but which is that if the company or not the company, if the founders or the shareholders, any of them wants to sell his shares, the right of first offer or the right of first refusal is triggered, and this means that you have to offer these shares to the other investors or to the other shareholders first, and if they say no, then you would be able to proceed and provide to be able to proceed and uh, uh, and have the transaction with the third party. If they say right, then they get the shares instead of that third party. And in both cases, when you notify them, you tell them like, I'm going to sell these shares for an X amount of money or against these terms and conditions. A preemption right is a little bit different, which relates to when the company raises capital, like increases its capital. So the subscription to the capital increase has to be offered also to the existing shareholders first before offering them to third parties. So the main difference between a right of first refusal and the preemption right, right of first refusal is given with respect to the existing shares, but the preemption right is given with respect to the capital increase. Tag along and drag along, usually people like mess them a little bit, but one of them is for the investors and the other one is for the founders. Or like, let's say one of them is for the majority and one of them for the minority. Tag along is for the minority, which means that, like, for example, if 3 people owns 40% of the company, or like 60, let's say 60 or 70% of the company, and they are selling their shares, then they would have to sell the shares of the minority with them. So I will tag along with them to be sold in the same transaction. Drag along is the other way around. So we have someone who wants to buy 100% of the shares, and we own only 60 or 70%. So we want to oblige the minority to come with us. So that's the drag along. So the tag along is for the minority to join, to oblige the majority to join them. Drag along is the flip side of it, where the majority oblige the minority to join them in the transaction. Does anyone have any questions about these 5 items? Anti-dilution, right of first refusal, preemption rights, tag along, drag along? Yes. Ziad, yes? Okay. I will move forward and then we can postpone the questions before the tips. So for the founders, you can have other provisions like for the founders, you can have the lockup, and the lockup means that they are locked into to the company, and you have to make sure that you understand this. There are 2 different types of lockup. You want to lock them up as like, employees and management of the company, and you want to lock them up as also in terms of like their transfer of shares. So you need to make sure that the term sheet cover both scenarios if you want that in the first place. And there is also reverse vesting for founders, which means that you make them like, earn their shares again through spending a certain period of time with the company. And then you would have good leaver and bad leaver provisions, which basically means that if you leave the company on good terms, you retain the shares. If you leave the company on bad terms, you have to sell back the shares at a very minimal price to the company. And then you have the ESOP, which is also one of the things that you need to worry about, whether it's post-money or pre-money. ESOP pre-money means that it dilutes only the founders. ESOP post-money means it dilutes everyone, including the investors that are joining this term sheet. So this is what you need to care about. Other than that, you will have here a link to explanation of the terms of the term sheet, like several links. One of them is on our website, and I also added others. Then you will see like samples for term sheets if you want to use them. There's one done by Carta, one done by Clara, one done by the National Venture Capital Association of the US, one done by the YC Combinator. And then we have this platform for showing you how to calculate like the conversion. This is the last thing in this part. I will do it now and then wait for the questions all together on the previous part. So here I will play a little bit. Okay. So here we have, like, for example, common shareholders who has, let's say, something like that. And here we will have nobody. Like they have here one.
Ibrahim, we still see the PDF.
Oh, okay. I'm sorry. Now you can see.
Yes.
Okay. So here in this scenario, we have common shareholders, which I will say, like, for example, these are the founders. Let's say they own 95% of the company, and unallocated options is that they have an ESOP, current ESOP, that diluted them, which is like pre-money ESOP for 5%. Okay. And then we have a safe and convertible notes holder. Let's say we have John Doe, post-money safe. Here you can change it from different things, but usually you choose between pre-money and post-money. Principal is the investment amount. Valuation cap is the first metric. If you have it, that's okay. If you don't have it, you will put 0. Discount here is 20%, and this is something that you have to know. In the safe itself, to put 20 in legal terms, you put 80. If you want to put 10, it's 90. If you want to put 30, it's 70. But it's just done this way because the equation has to be done in a certain manner. So when you see a safe which says 80, actually this is not 80% discount. This is actually the flip side of it, 20% only. And if you see a safe with 90%, this actually means 10% and so forth. But here in that platform, you use the actual one, which is 20 or 10, not the 80 and 90. So here two money saves, two post money saves, one for $100,000 and one for $25,000. Here's the next round. Let's say we are raising at a valuation of $6 million. That's the pre-money valuation, and we are raising $500,000. Okay. Here in this option, you need to be clear about. You need to understand what does this mean. It means that whether the shares issued to the convertible note holders, the safes, are included in the denominator or not. This is actually one of the tricky things because it's not usually included in the safe what will happen in that scenario. But usually the founder will press yes on this to make sure that the investors are happy. So the investors want this to be yes, the founders would want this to be no. Here, the new ESOP, whether it will be pre-money or post-money. So let's say it will be post-money for 5%. Here's the new investors, the price round. So here's the breakdown of this 6 million valuation at 500, which means that here, for example, he will contribute for $300,000, and he here will contribute for $200,000. This is investor, let's say, priced round investor A, price round investor B. Here it shows how the post money is calculated, how the post money saves is calculated. So John Doe, you remember his post money save was for $100,000 at 3 million valuation cap at 20% discount. So here the valuation cap denominator, here the valuation cap price share, which is when they apply the valuation cap, and here's the discounted share price when they apply the discount rate. You'll see if we apply the valuation cap, he will get a less price per share. If we apply the discounted price per share, he will get more. So that's why they are using here the conversion price. They are using the one which is the valuation cap. And here's the number of the shares converted as based on the internal calculation that they are doing on the platform. As you can see here, he was raising principal for 3 million valuation cap and 20% discount. The difference between him and the other safe holder is that the valuation cap is much higher. It's 5 million. So here you will find actually that the discounted share price is better for the second safe holder than the valuation cap price, and that's why they are using that as the conversion price. So that's something that is very important to note, that you need to model the rounds to see what is happening exactly and which is used before you raise the safe, not after you raise the safe. So you need to know this before you raise the safe, and you need to play with this amount. So for example, if I put here 4 million, it will be basically the valuation cap will be better for the safe holder, and this is the conversion price that will be used, which means that this will hurt the startup founder more and it will benefit the investor more. So that's why you need to be careful with that. So as you can see here, this is the final cap table. So we have unallocated options of 5%. This is from the beginning. This is not allocated anymore. This is not allocated. This is not new. But this is the new. One second. Because here it's one second, pre-money. Yes. If we do it pre-money, it will stay 5%. If we do it post-money, it will be 5% also, but the number of shares will be different. So it doesn't matter. So that's why you have to play with it, because like it's a little bit tricky. So here you have founders, they were 95%, they became 78%. Thomas Smith, which is one of the safe holders, will have 5.6% for $25,000. Investor A, who paid also who paid $300,000, will have less percentage than Thomas Smith. So more money, but less percentage because he invested at a later stage. Investor B will have like 3.05, which is also similar to John Doe, although Investor B paid $200,000 and John Doe paid $100,000. And here with the options, you will see that they pool together. If we do this and do this, because this is not allocated, yes, you will find it the same because it was unallocated from the beginning. That's one of the things that you have to be careful about. Whether when you have an existing ESOP, you will need to know in the wording of the term sheet that the new ESOP, that whether you will do a new ESOP or you will just amend the old ESOP and say like, I allocated already half of it, so the remainder is like 2.5% only, for example. So the ESOP is one of the tricky things, and I have a link in the PDF that shows everything about the ESOP and also the advisors and the conversion of their shares. ESOP is an employee stock ownership plan, yes. There are some questions in the chat. The difference between the preemption right and the right of first refusal. Preemption rights applies to capital increase only, while right of first refusal applies to existing shares. So that's the main difference. But they're both treating the same thing, which is like, if you want anyone from the outside come in, you have to offer everything to the existing people first. And if they say no, then you can get outside and get external shareholders. Can an investor negotiate both drag along and tag along? Yes, an investor can and should negotiate both of them. He should go for, it depends on how much percentage he will have now and how much percentage he thinks he will have later if he's going to invest later on, and should try to see like how is the threshold for applying both of them, because you can say like, only 70% can call for that, or only 50% or only 60%. So these percentages can be negotiated, of course. What does ESOP stand for? Is yes, Omnia, as I said, employee stock ownership plan. Employee stock ownership plan, which means that you're offering shares to the employees at a very minimal price in order to retain them and make sure that they are happy with the company and so forth. And this is very common in the startups, much more than mature companies. So if anyone has any questions, please go ahead, and then we'll have the final part of the question. Yes. Okay. Muhammad, yes.
Hi, Marish. Can we go over the lockup part again and
Yes.
the good leave, bad leave part as well?
I'm sorry if sometimes I go over things quickly because I want you to focus on because there are a lot of things, so I want to be focused on more on some things more than others.
No, it's
But
okay. We get carried
yeah,
away then because everything's so interesting. That's more than fine.
so lockup means that you say that you as a CEO has to it can be one thing or two things. You can say like this CEO has to stay in the management of the company for 5 years, and you can say also that this CEO has to stay in the company for 5 years and cannot transfer any of his shares during these 5 years. So the lockup can apply to his employment status and his share status. And then you can have a reverse vesting with it, which means that the founders, like, revest their shares from again, which means that, it's as if we say that the founder doesn't have any shares now, and he will be vesting, or he will get these shares acquired over time, over like 4 years, for example. That's the typical. And then good leaver and bad leaver means that if the founders leaves during like this period, 2 years, then he will get what has been vested till that time, and that's it. If he was a good leaver, which means that there's conditions for it, but basically leaving on good terms with the company. But if he is leaving as a bad leaver, then he will sell back his shares at like 0.0001 cent, and will not get anything from the company because he didn't leave on good terms.
Okay,
And
thank you.
lockup and reverse vesting are not they are not found in each term sheet. It depends. It varies from one term sheet to another. But like, for example, the drag along, tag along, preemption rights, right of first refusal, anti-dilution, board composition, protective provisions are usually all included in the term sheet and in the subsequent documents as well. I want to stress on this point that this term sheet is not binding, so you have to turn it into something that is binding, which is usually a subscription agreement or a subscription agreement and a shareholder agreement, or both of them done in the same document, and it's called as subscription agreement and shareholders agreement together. Okay. So I'll move to the last part, when to raise safes. Usually, the founders should raise safes at the beginning when they don't really know how much to value the company. So, and going back to Ahmed's question about how much valuation cap will be put, this is actually one of the funny things about startups. It's very unscientific. Yani, I've seen things that are very variant, and I don't know why that company has a valuation cap like this and another company has a valuation cap like that. It's very disturbing to me. There's no clear answer, but basically it's based on the negotiation. Maybe the profile of the founders matters a lot. So maybe like a startup that is not even created could be valued at a very high price because of who's founding it. When to raise a priced round, usually you raise a priced round when you go to the venture capital funds. They need to do it through a priced round. So usually that's when you do a priced round. Angel investors don't care much about priced rounds, so that's helpful. When a shareholders agreement is needed, when the price round is done, you need to have a shareholders agreement to make sure that you are converting everybody from the safes, and like everybody from the founders is included, and also the new shareholders are included, and everybody knows what are the rights against each other. The subscription agreement, what it's different, that it's done between the investors in the price round only and the company. But the shareholders agreement is an agreement that covers everybody. And as I said, the subscription agreement part can be included in the shareholders agreement just to avoid like having like many documents together. So that's also something to note. Arranging the VDR, the virtual data room. So the VDR is basically like a OneDrive folder, or like a Google Docs folder that includes all the documents that of the company and send a link to the investor to check them and do the due diligence. In the due diligence, usually it's done when there is a Series A round. And here are a list of the things that you need to worry about from day one to make sure that they don't bite you when you when you are trying to raise money in a priced round format. So labor issues, social insurance issues, having the IP assignment annex, which means that the IP is assigned to the holding company. Also IP trying to register it, a stitching between the mother company and the operating subsidiaries, which means that you have one holding company that is 99.9% or 100% owner of all the subsidiaries everywhere, having terms and conditions or template agreement for the sale of your product and services. Data protection is very important right now, and also data protection is done at a global level. So you need to comply maybe with the GDPR, with the California Privacy Acts, and others as well. If you're selling a B2C, then consumer protection issues are important. And at the last, licensing issues need to make sure that you have all the licenses in place, and some of them are can become very tricky. Last thing, ESOP and advisor options. I added a link because ESOP is a little bit tricky, and advisor options also is a little bit tricky. About, and when I say tricky, I'm talking about how much you should have as an ESOP, and whether how much of it is pre-money and how much of it will be post-money, and same also for the advisors options. Also, if you are doing advisors or ESOPs for US taxpayers, which could include US residents or US nationals, then you would have to do a valuation, well, something called 409A valuation, which is a little bit tricky, but you can do it, of course, but it takes time. So this is something also that you need to be aware of, that if you are raising from someone who pays taxes in the US, he doesn't have to be a national, but he can also be definitely all nationals are taxpayers, and also some residents are taxpayers. Okay, the recommended resources and readings, Cooley Go is very good. I like it a lot. But as I told you, like everything has to come with a lawyer. That's the best, in my opinion. And there's these two books. I think both of them are written by lawyers. Secrets of Sand Hill Road is a lawyer who become the GP, the general partner, or of one of the biggest venture capital funds. And at the last venture deals book, I think a lawyer, but I don't know if he's doing VC as a business or is still advising VC funds as a lawyer. And you'll find links to Amazon to these books, and also Cooligo here, Cooligo platform. You'll find a link to it, and that's basically it. Okay, so if anybody has any questions, please go ahead. He said, there's a question here. What is the difference between an equity term sheet and a shareholders agreement in terms of their content? In terms of their content, shareholders agreement would have mostly all the provisions, but it will more fleshed out, very detailed, much more detailed. But the core is the term sheet, and then you turn this term sheet's conditions into something much more detailed into the shareholders agreement. For example, in the term sheet, you can say anti-dilution clause will be subject to or will be done in the form of full ratchet. But in the shareholder agreement, you will explain what's a full ratchet and what is the equation will be used and what are the exceptions and so forth. I hope that I was clear during the session. If anything is unclear, please feel free. This is my email, and I'm always responsive on LinkedIn. And also, this is my number. If you prefer WhatsApp, I'm fine. Ziad, please go ahead.
Mr. Ibrahim, can you send to us this PDF and this recorded session via email or
During the upcoming week, I'll make sure that you will have access to both of them.
Okay, thank you.
You're welcome. If anyone has any feedback, especially if it's a negative feedback, that would be great to note in order to make sure that if I do this again, hopefully I will do it again, that it's a better version. And you can do that now, chat, email, whatever you like. It's fine. So I will wait for a couple of minutes if anyone has any question. I will be happy to answer. Thank Ahmed Salim, please go ahead.
For me, because I'm from a financial background, I think we need to have always numbers after each point so we can understand more of the thing. I think this can be in the next time when we start talking about point by point in details. But for me, I prefer numbers, examples to understand things. Specifically in this post money and these things, I need numbers.
Yes, of course. You're right. Numbers makes clear, but so the problem is with that is it has to be done for non-legal professionals only, because legal professionals don't like numbers. So what I've done as a compromise, I like numbers. I don't mind numbers. But what I've done as a compromise that you will see like the specific parts that's like the pre-money safe versus the post-money safe and how is that calculated and how is that calculated. You will see a link in the PDF to an article that shows that very clearly. So hopefully that would be helpful. But I take your point, maybe like split it in two sessions, one for safes only and one for term sheets only. But yeah, I will try to do that, inshallah, soon, inshallah.
Thank you.
We can talk about offshoring, of course, which has a lot of issues. Abdurrahman Bidir, yes.
So it's just a generic question. Is there any relationship between venture capital and M&As?
Is there any what?
Relation between venture capital and M&As?
I cannot hear the word between any what? Between venture capital and M&As. Any?
Yes, that's the question.
So M&As, so price round is similar to M&As in some issues and is not similar in other issues. We can talk about that at length, but basically price round in venture capital is a bit to it's quite similar to an M&A in terms of like what does it mean and what will happen and all that. But the terms and conditions are a little bit or are like different to like 30 or 40% different between venture capital and M&As because of the nature of the industries are different. This is a mature company that generates profits. So this is a startup that is still not generating profit, but has the potential of being like a unicorn or something like that. Does this answer your question?
Yeah, thank you.
Thank you. Ziad, yes.
I want to know the difference between safe agreement and the KISS agreement.
I didn't want to dig deep into that, but you can, if you do like online, you will find several articles on that point, but KISS are much more less used, يعني maybe 5%, and the safes are like 90%. So you have to worry about the safes much more than the KISS. The KISS are being done by Global 500, and they're not very common, at least in our part of the world, in the MENA region. So my advice is maybe you get to know what is a KISS. There is some differences in the metrics. I didn't do one KISS till now. I saw one or two, but I didn't do any KISS. Like I did a review one or two, and that was a long time ago. So I didn't prepare for it actually for this session.
Okay.
رضوى.
ايوه، هو حضرتك سامعني كده؟
يس.
طب هو ممكن حضرتك السيشن الجاي يعني تتكلم حبة عربي وحبة انجليش، عشان انا في حاجات اصلا مش بفهمها، عبال ما بروح اشوفها في الديفينيشن وكده بلاقي حضرتك سبقتني، فحاسه ان انا عايزه اعيد السيشن مرتين عشان افهم كل كلمه.
حاضر، ممكن نعمل سيشن بالعربي.
ماشي، اوكي، شكرا.
نعم. عمر.
Yes, I have a question about setting up the local operating company in Egypt. Is it usually set up in accordance with the laws of the FRA or GAFI?
FRA applies only when it's a fintech company or like relating to the financial non-banking services, and it will be done in FRA in that time. So if it's a fintech company that operating in a gray area that doesn't require a license yet by the FRA, then it will be incorporated in GAFI. If it's a fintech that needs a license, like for example, microfinance, nano finance, brokerage, insurance brokerage, what else, robo advisory, all that, then you would need to incorporate it with the FRA, and it has different rules and regulations. And also you need to worry about the obligation to have 25% owned by financial institutions, which apply to several of these types, not all of them. And also the capital is different and all that. And there are exceptions for fintechs, and there's the regulations on the fintech temporary license, which like reduces the capital and or has a capital minimal capital that is less than the original one. But all other startups like agri-tech, health tech, all that is with GAFI.
Okay, thank you.
هو سوري انا عم بسأل انا ما عندي فكرة عن القانون المصري، ما بعرف اذا عم تفهموني، انا لبناني من بيروت. ما بعرف اذا عم تفهموا شو عم بسأل، بس حضرتك سألت في جافي وفي اف تي ار
دي
بمصر.
جافي. هو كله بيتكلم عربي، انا ما اعرفش، كان في اجانب بس انا مش متاكد بصراحه. جافي refers to اللي هي الكومباني اوثورتي، اللي هي مصلحه الشركات. اف ار اي
اوكي
هيئه الرقابه الماليه. احنا عندنا في مصر الوضع بس بيختلف. في بعض الشركات اللي هي بتقدم على رخصه الرقابه الماليه لازم بتتاسس مع هيئه الرقابه الماليه نفسها، والشركات
اوكي
بقيه الشركات كلها بتتاسس في مصلحه الشركات عادي. فحتى اللي بتتأسس مع
اوكي
الرقابة
اوكي
المالية بيبقى فيه برضه حاجات بتعملها في جافي وكده. بس يعني بيبقى معظم الناس بتأسس في جافي.
اوكي شكرا لكم. انه نحن ببيروت مش هيك الحالة ابدا، يعني غير شيء يعني. نحن
أنا
غير
عارف، لا،
وضع
كل دولة
عنا،
مختلفة طبعا.
غير وضع عنا. ميرسي لكم، وسوري يعني بنحكي بالعربي، بس بالعكس هي لغتنا هيدي ونحن بنفتخر فيها وبنفتخر بأهل مصر. وشكرا لكم عن جد، أدامكم الله بألف خير. أنا صديقتي مصرية وبعرفها من زمان، وبالعكس أطيب شعب خلقه ربنا عن جد، مش
ربنا
مجاملة،
يخليك.
أنتوا أحلى شعب. فأدامكم الله بألف خير، والله يزيد من أمثالك أستاذ إبراهيم.
ربنا يخليك يا إيلي، ربنا يخليك. تسلم. كان في سؤال على الشات. What are the governing regulations to venture capital؟ venture capital هو بتتأسس كصندوق رأس مال مخاطر. بس هو يعني احنا ممكن نتكلم على دي حتة لوحدها، لأن هي الصناديق رأس المال المخاطر اللي موجودة في مصر كلها معظمها يعني يعني مش شغالة قوي بالرخصة دي، يعني هي بياخدوا الرخصة بس بيشتغلوا أكتر بالرخصة بتاعة الفند الأم اللي هو موجود بره مصر يعني. بس دي ممكن نتكلم فيها الحتة لوحدها يعني، لأن هي دي مختلفة عن الكونتنت بتاعي النهاردة. آم، طيب تمام. شكرا يا جماعة، وأتمنى إن أنا يعني أكون يعني أفدتكم بأي حاجة، وإن شاء الله I will send the PDF والrecording إن شاء الله الأسبوع ده بإذن الله. Thank you.
شكرا جدا.
Thank you. باي باي.
باي باي، شكرا لكم، يعطيكم العافية.